Hello guys, so today I'll be going over O-level accounting paper 1. This is the most recent accounting O-level paper that happened in October-November 2021. This is the new code 7707. This is paper 12 and you have 1 hour 15 minutes to attempt all the questions. Now, as we all know that this is an MCQ based paper, there are total 35 questions that you need to answer, and each question is given with 4 options. So now, starting off with the question. So starting off with question 1, it's saying which statement is correct. A, the accountant prepares the trial balance and the bookkeeper prepares the financial statements. No, this is not true. Why? Because the accountant is actually the one preparing financial statement. Part B, the accountant writes up the journals and the bookkeeper writes up the ledger accounts. This is also not true. The bookkeeper writes up the journals and the accountant prepares the trial balance. Not really, because the bookkeeper is recording the day-to-day transactions. The bookkeeper writes up the ledger accounts, yes, and the accountant prepares the financial statements, yes. So D is the correct one. Why? Because we know that bookkeeper is actually the one who is writing the ledger accounts, as in making the day-to-day entries, and accountant is the one who is preparing financial statements. So this is the correct statement. So for question 1 we choose the option D. Moving on to question 2, which formulas may be used for the accounting equation? Okay, so we all know accounting equation is capital is equals to assets minus liabilities. Now they have given us in different forms. So we have assets is equals to owner's equity minus liabilities. So owner's equity is actually the same thing as the capital, and then we have liability is equals to assets minus owner's equity. So like we can also write this in this form, right? Capital plus liabilities is actually what's equal to assets. So owner's equity is equals to assets plus liabilities. No, owner's equity plus liabilities is equals to assets. So yes, 2 is making sense, because if we just switch them, so we know that L is equals to assets minus capital, right? And even for number 4, owner's equity plus liabilities is equals to assets. So yeah, we choose option 2 and 4. That means option C. Question number 3, goods purchased on credit from Zamir were returned by Ashwin. So purchased on credit from Zamir were returned by Ashwin. So that makes Zamir the supplier and Ashwin is the customer. Which entries should Zamir make to record this? Now it is very important when we're reading these questions, we need to make sure from whose perspective are we actually looking at the transaction. So that will help us identify what needs to be done. So Zamir, like we said, that he is actually the supplier and Ashwin is the buyer. So Zamir has to record this entry. Now Zamir will, the account that needs to be debited over here is definitely sales return, because Ashwin is returning goods to Zamir. So we only see one option with that, sales return is debit and Ashwin account will be credited. Why? Because when Ashwin was the buyer, so we must have, as we sold him the goods, so we must have debited his account with that particular amount. So now when he has returned that amount to us, we are simply deducting that amount from him, as he no longer owes us that. So that's why Ashwin is account is being credited. So we choose option C. Moving on to question 4, during her first financial year, a trader paid 1800 for insurance and 3200 for rent. First financial year. At the end of the financial year, she transferred insurance of 1500. So she transferred insurance of 1500 and rent of 3600 to the income statement. Now we only record the amount that is qualifying for the whole year, no matter it has been prepaid or accrued. So that's what the accrual and matching concept means. So what do the balances remaining on the accounts at the end of the financial year represent? Okay, so the question is asking that the remaining balance that has been transferred, what is that showing? So it might be prepaid or it may be accrued. So when we look at the amount for insurance account, for the insurance account, the first financial year he paid 1800, and at the end of the financial year she transferred insurance of 1500. Now this means that the amount is actually being reduced. So total 1800 was paid, but in income statement we're only recording uh, the amount of 1500. So there's an excess of 300, which means that when we were making the income statements we might have deducted this 300, and we all know that we deduct a prepaid expense. So insurance account must have been prepaid. Now there are two options for prepaid expense, C and D. So this simply helps us identify if we are not selecting A or B. Now looking at the second one, now rent, again an expense for the amount that was paid for the year was 3200, and at the year end this 3200 amount they're actually recorded in income statement as 3600, right? So that means they have recorded more in the income statement, which is a very clear indication that this excess of 400 has been added to that previous 3200, and that's why this is an indicator that this was an accrued amount. So this is an accrued expense. So we can safely say we are choosing option C, whereas this is insurance account is prepaid and rent account is accrued expense. Moving on to question number 5. Question 5, Lee bought goods 8000 less 15% trade discount. We know trade discount is given to any customer at the time of finalizing the deal, and cash discount is what we give to a customer or what we receive when we are making the settlement. So in order to pay quickly we might be giving a cash discount. So this is a trade discount of 15%. She later returned half of these goods as they were faulty. Okay, so half of these goods were returned. Which document did Lee issue to the supplier for the returned goods? Okay, whenever we're talking about returned goods, we talk about two main documents: credit note and the debit note. Now debit note is issued by the customer to the supplier, and in order to identify that these are the goods that we are returning, and the credit note is issued by the supplier to the customer to clarify or to give them a surety that their account has been credited by that particular amount that they have returned. So which document that Lee issue? Now we know Lee is the buyer over here, so issues to the supplier. So we need to give the name of the document. So that means we are talking about a debit note, because debit note is the one that the buyer issues. So we have two options for debit note, and then this was, she returned half of these goods, so 8000, that makes a half of 4000. But remember there was a 15% trade discount. Now if we take 15% trade discount, that means 8000 was only the amount that she actually had to pay was only 85%. So the actual amount that she actually owed was 15% less 8000, and if we deduct 15% from 8000, the amount that we are left with is actually 68,000. So she actually owes 68,000 and she is returning half of it. so half of it will be 3400, sorry. So we can say that she is issuing a debit note of 3400. Moving on, question 6, what is a check counterfoil? Okay, now check counterfoil is actually that small part in a checkbook that stays with you once you write the check and you enter the details of that check in that small part. So part A, to make a credit entry in the bank column of a cash book, exactly this is what it is used for. To make a debit entry, there's no need even to look at the other options because we know this is what it does. So a check counterfoil is that small part. So suppose like we've all seen what a checkbook looks like, and mostly these checkbooks have this part where you tear the check, and no matter whatever check you have written, there's always these small pieces of information that are with you in that checkbook. So that is what the check counterfoil is, and you use it to make all the credit entries for the payments that you have done in your cash book. Moving on to question number 7. Farooq sells goods on credit. A check from Khalid, a credit customer, was dishonored by the bank. How should Farooq record this? So Farooq is the seller over here. We are recording from the seller's perspective, and Khalid, who was the customer, his check has been dishonored. So we do know that this is something where the account will now be debited again because we did not get the money from this person. So the two options that have account as debit are C and D only, right? So Khalid account will be debited again. Why? Because that money was not received, and we'll simply credit our bank account. Why? Because we did deposit it, and we are not recording it as a irrecoverable debt. Why? Because this is just a dishonored check. There is no mention of this debt going bad, so we will not record it as irrecoverable debt unless and until that is proven. So this check might be dishonored due to any genuine reason. So the simple entry to record this will be that Khalid account is debited and the bank account will be credited. We're actually crediting the bank account because when we received the check from Khalid, what we would have done is that we must have credited the Khalid's bank account, the Khalid's T account, and we must have debited our bank account with that same amount. So now when that check is coming no more, so we simply credit the bank with the same amount and we debit Khalid with the same amount. Moving on to question number 8. Why does a supplier offer trade discounts? Well, I did mention this earlier that trade discounts are usually given at the time of making a deal. So part A, to avoid irrecoverable debts. B, to encourage bulk buying. Yes, this is one of the main reasons to give trade discounts. C, to encourage payment in cash. D, to reward prompt payment. Actually these two are the main reasons for giving the cash discount, right? So I'm just going over the concept so you can remember this, that when we're talking about trade discount, so this is usually when we're trying to encourage bulk buying, or we're trying to finalize a customer and we're trying to finalize a deal. And on the other hand, to encourage payment in cash or to reward any prompt payment, that is where the cash discount comes in. Moving on to question number 9. And maintains a petty cash book using the Impress system. So we know that the Impress system, petty cash book, is the one where we are recording the values. Which statement is not correct? A petty cash book can be maintained by a junior member of staff. Well, this is true. These are usually done by junior members. At any time, petty cash voucher plus the petty cash balance are equal to the impressed amount. Well, that's what the impressed system is actually, because that is like a running total. So at all the time this will be equal to the vouchers and the petty cash balances. So again, this is also true. The chief cashier is not asked continually for small sums of money. Uh, Again, this is also true. Why? Because they have been given their limit, and that's what the impress system is. So they are given a limit of 50, and they will be using up whatever that they used up. And suppose they are left with 15. If they have used up 35, they're only left with 15 in the end. So next month they will get suppose 35 more to make that balance of 50. Number D, the number of entries in the cash book increases because of the large number of small cash payments. Yes, that's this is something that is not correct. And as we know, as we can also see that all these three are correct, then obviously it's the option D that is not correct. Question number 10. A sales invoice for 800 was incorrectly recorded in the sales journal as 1800. How did this error affect the trial balance? So the sales invoice was for 800 and this was recorded as 1800. How did this error affect the trial balance? Again, now this is the trial balance, but both totals were overstated. Yes, the trial balance will balance because this is the error. That's not affecting the trial balance because the sales invoice is for 800 and the sales journal it is entered as 1800. So trial balance will be balanced, and B, the trial balance balanced, but both totals were understated by 1000. So we go with option A, that is the trial balance balanced but both totals were overstated by 1000. Moving on to question number 11. A standing order paid for rent has not been entered into the accounting records of the business. We know a standing order is an instruction given to the bank to make any fixed payment on a monthly basis. So most of the time it is recorded in the bank statement, but we may not remember it, and it is not recorded in the cash book. So which statement is correct? Part A, because the payment was made automatically, no additional entries were required in the accounting records. Okay, the payment was made automatically, but we cannot say this is completely correct because obviously we need to record it in our accounting records. Part B, because payment was made automatically, only an entry in the rent account is required. Not really, because we have to make this entry in our cash book also. Entries are required in the cash book and in the bank reconciliation statement. And the part D is saying entries are required in the cash book and in the nominal general ledger. So this is what is actually correct, that when the standing order paid for rent was not entered into the accounting records. So the accounting records of business are firstly the cash book and the nominal journal ledger, where you will be recording your payment of the rent. Moving on to question number 12. The bank statement of a business had a credit balance of 2690. Now this is the bank statement credit balance, and we know that bank statement will be showing a credit balance indicating that this is the amount of money that is there in our bank. At that end, checks totaling 850 had not yet been presented for the payment. What was the bank balance in the cash book on 1st October 2021? So bank balance on the cash book. Now we know that this amount was 2690, and at that date checks totaling 850 had not been presented. So these are the unpresented checks, and we start off with the cash book balance. We add unpresented checks. Over here we have been given the bank statement balance, so we have the bank statement balance of 2690. Instead of adding unpresented checks, we will simply less unpresented checks, so this is 850. So 2690 minus 850, as these checks have not yet been presented in the bank, for so this amount has not been deducted yet, and with this we get a value of 1840, right? Now there are two options for 1840, A and B, whether it's 1840 debit or 1840 credit. They're asking us for the bank balance in the cash book, and in the cash book this will be a debit balance because that shows that this is the amount of money that we have. Its bank statement will be showing a mirror image. In bank statement, a credit balance means that this is the amount of money that we have in the bank, because for a bank our deposit is actually their liability. That's why they show it as a credit balance. So we will be choosing option B, 1840 debit. Moving on to question number 13. A trader purchased new business premises. What are examples of capital expenditure? So capital expenditure is the long-term expenditure that we're doing mostly on the assets. The options given over here are cost of heating and lighting the new premises, cost of purchasing the new premises, legal cost of purchasing the new premises, office furniture purchased for use in new premises. Now first of all, number 2 will apply because obviously cost of purchasing the asset is part of your capital expenditure. Then also any legal cost of purchasing that new asset are always capitalized. That means they are included in your cost. So that is also a capital expenditure. And then any expense that is being done to bring that asset in usable condition, that will also be capitalized. So over here the office furniture that was purchased for use in the new premises, now again this office furniture is also your asset. It will serve you for a longer period of time, and you cannot really use your new premises unless and until you have furniture or fixtures and fittings into that. You won't just be sitting in an empty room. So all of these three items will actually be capitalized. So option C, where it says 2, 3 and 4. Moving on to question number 14. Two companies each purchased a motor vehicle for 10,000 at the beginning of year 1. Company G used the straight line method of depreciation at a rate of 15% per annum, while company H used the reducing balance method at the rate of 20% per annum. What was the difference in the depreciation charge between the two companies for year 2? Okay, so they both purchased the same motor vehicle for 10,000, so the cost is the same. Now we do know that under the straight line method we are reducing the same amount every year. So if we are taking out 15% of 10,000, that gives us an amount of 1500. And if this was 20% per annum as per reducing balance method, so we know for the other company, company H, for the first year it will be 20% of 10,000, so that will be 2,000. And then next year under reducing balance method, this 20% will be on the net book value, so the net book value will be 2,000 deducted from 10,000, so 20% of 8,000 will be 1,600. Now as we can see, the question is asking what was the difference in the depreciation charge between the two companies for year 2. So in the second year, if we compare the depreciated amount, company G is charging 1,500 and company H is charging 1,600. So we can see that this is 100 greater for company H. so we choose option B. Question number 15. At the end of the financial year, Mui had prepaid rent of 1500. So this is a current asset. How should this be recorded? A credit 1500 in the bank account and carry down as a credit balance. No, whenever we have a prepaid rent, that is a current asset and that is always carried down as a debit balance. So credit 1500 in the rent account, true, and carry down as a debit balance. So we will be choosing option B. This will not be debited in the rent account. Why? Because this is a prepaid expense and prepaid is always shown on the credit side and brought down as a debit balance. Moving on to question number 16. After preparing draft financial statements at the end of her first year of trading, Lucy discovered two errors. One, damaged inventory had been valued at cost price. It was expected to sell for 180, and point 2 is stating 100 items which had been expected to sell for $12 each had been valued at their cost price of 7 each. Carriage inwards of $1 for each of them had not been included in the cost. What was the effect of these errors on the gross profit? Now this is something relevant to the IS2, where we state that closing inventory should be valued at lower of cost or net realizable value. So whatever is lower, so suppose if cost is lower than the net realizable value, and net realizable value is what those inventory will be sold in the market for. So whichever amount is less, so if cost is less than NRV, we will be valuing inventory at cost, and if it is vice versa, suppose if NRV is less than the cost, so we will be valuing it at NRV. So let's just look at these. This is asking what was the effect of these errors on the gross profit. So on the first one, what has happened is that the cost price is 340, it was expected to sell for 180, so that means that they have overstated their clothing inventory by the difference. So if we simply take out the difference of 340 and 180, because we know that the net realizable value is 180 and they're overstating it by 160 if they're recording it as 340 in their accounts. For the second item, these are 100 items which are expected to sell for 12 each, valued at their cost price of 7 each. Now so the cost price is 7, so 7 into 100 will be 700, and there is a carriage inwards of $1, so 700 plus 800 700 plus 100 makes it 800. Now they have valued for each item had not been included in the cost, so carriage inwards is not has not been included in the cost. So over here they're already stating at it at the lower of cost, because cost is lower than the selling price. However, the difference is because of this 100 carriage inwards that they have not included in their cost. So this should have been 800. Now the overall effect on the closing inventory will be, because this 100 will cut down 100 from the 160 that it was originally overvalued at, so the closing inventory will be overstated by this value of 60. And when the closing inventory is overvalued, that means gross profit will also be overvalued. So we can easily say that gross profit is overstated by $60. So this was a bit confusing question, and this may require a little more time in calculation, but the key is that you read the question carefully. So this part has been done correctly, but the main effect was arising due to these carriage inwards not being included, and this damage inventory in part 1, this was clearly overstating the closing inventory by 160. However, this was not included, so this 100 counter affected that 160, and the closing inventory was overstated by 60. So the gross profit is also overstated by 60. So we can say that there is a positive relationship between the closing inventory and the gross profit. So whenever closing inventory is overstated, gross profit will also be overstated, and whenever closing inventory is understated, the gross profit will also be understated. Moving on to question number 17, which is an advantage and disadvantage of operating as a sole trader? This is a pure theoretical question. So a sole trader has the advantage that he has all the profit with him. The advantage gains all the profit. Two options given to us. Let's look at the disadvantage. Bears all the risk, control the decision making. So obviously for 17 we will be choosing number A, because sole trader is the risk taker and he is gaining all the profit too. Moving on to question number 18, what is shown in the capital and liability section of a statement of financial position of a business? So the capital and liabilities section will be showing the money that has been invested. So the options given to us are A, how the resources are being used by the business, B, the working capital of the business. No, the working capital is simply current assets minus current liabilities. C is total amounts owed by and to the business. No, that is only the liabilities. And D is where the resources of business have come from. So exactly this is what the capital and liabilities shows us, because the resources that are owned by the business are the assets, and these assets might be purchased from the capital that was invested in the business, or the liabilities that have the long-term liability, the bank loan that the business took. So obviously they are using that money to run the business. Moving on to question number 19, John maintains a full set of accounting records. Why does he also prepare the statement of financial position? To calculate the profit for the year? No, that is what we use income statement for. B, to check if assets equal capital plus liabilities? No, not really. That's not a real good definition for statement of financial position. To show the transactions which took place during the year. And D is to summarize what the business owns and what it owes. So yes, we will be choosing option D, because this is what a statement of financial position shows. It shows a summary of the business assets, capital and liabilities. So what the business owns and what it owes. Moving on to question number 20, a sole trader paid off the business overdraft using his own personal funds. How did this affect the statement of financial position? So business overdraft using his own personal funds. So very first thing, whenever we look at new personal funds or new investment coming into the business, that means one thing, that the capital is being increased. Now if we look at the column of capital, we see that there are three options which says that capital will be increased. So at least we know that this is not D. And now moving on to the assets and liabilities. So because this was business overdraft, now we know that overdraft is actually a liability. So once we have paid that overdraft, that means our liability has decreased. Now again, looking at the options, we can now see that this brings us down to the two options where the liabilities are decreasing, and that is B and C. So we have to go on to the last one where we look at the assets. So the assets will not be affected. Why? Because when he is bringing in money into the business, that money is not going into the bank account as a positive balance. That is actually going in the bank account to cover up the negative balance that was over there because of that overdraft. So we can safely choose option C. Now there are many questions of this sort where you have to choose different options, and like there were three categories that we were looking at over here: liabilities, capital and assets. And this strategy of cutting down on your options sometimes really help you out, because sometimes there might not be a need to go and look at the third category, because if we only had one option where liability was decreasing, we would have easily selected that, but like you saw that I had to go on and look at the effect on assets because there were two options for me. So I hope the way I am solving these, this is helpful to you and you are able to grasp this skill. Moving on to question number 21. Hassan found that he needed help to run his business. He decided to take a partner rather than employ an assistant. So he is now turning it into a partnership. Why did he decide to take a partner? Number one, an assistant would not interfere with how the shop was run. Two, an assistant would not share risk, right? So this can be a reason that assistant will not be sharing the risk, the partner will be sharing the risk. And then a partner would introduce some additional capital. Yes, the assistant will just be an employee, he won't be putting in any extra capital or even extra effort to make the business successful. And number four, a partner would take a share of the profit, right? That is a reason too, but when we look at the options, we have option 2 and 3 present in this C part, so we just go with that. So this is the main reason why he decided to take the partner for number 2 and 3. Moving on to question number 22. Anwar is a sole trader making annual profits of 24,000. He decides to admit Dilip as a partner. They agree that Anwar would receive a salary. So Anwar is receiving a salary and profit and losses will be shared equally. The forecast appropriation account for the partnership first year of trading is profit for the year, salary Anwar deducted, we are left with distributable profit of 40,000. Now, by how much will Anwar's total income increase, right? So the total income for Anwar will be increasing by the profit share that he is getting. Now the distributable profit is only 40,000, and we did mention earlier that this profit is shared equally. So when the profit is shared equally, that makes the amount for each partner to be 20,000. Now the question is asking how much did his income actually increase by. So initially when he was not working as a partner, he was receiving 24,000. Now he is getting 20,000 in form of the profit share and 10,000 as a form of salary. So if we look at it in terms of the total income that he is receiving, so now he is getting a total payment of a total income of 30,000, and comparing that 30,000 to what he was getting initially, we can see that there is an increase of 6,000. So we can say we choose option B. Why are we doing that? Because the question is asking the total income increase. The word over here that we really need to concentrate on is the increase. If the question was simply asking how much income did he receive, we could have given the option of 30,000, or the profit received was 20,000 as the profit share. But when they are talking about the increase in income, we will be comparing it with the initial amount that he was receiving before he was operating as a partnership. Now moving on to question number 23. So BCD Limited provided for the following information: ordinary shares and retained earnings, debentures, how much was the equity, and the capital employed. So we know that when we are calculating the shareholder equity, ordinary share is part of equity and retained earnings is part of equity. So 3000 plus 300,000 plus 200,000 makes up 500,000. So equity options of 500,000, again we have two options, C and D, so we will be choosing from that. And capital employed is all the money, any equity plus long term liabilities. So uh, for capital employed we will be including all these three, so that gives us 670,000. Always remember that equity does not include any long-term liabilities, whereas capital employed does include long-term liabilities, because then again that is the capital that has been employed in the business. Any long-term loan that the business has taken, that is being used in the day-to-day operations of the business, and that is actually the capital, that is part of the capital that has been employed in the business. Moving on to question number 24, the issued share capital of CD Limited consists of ordinary shares. Retained earnings were 86,000 on 1st September 2020 and 88,500 on 31st August 2021. The company made a profit during the year of 26,000 and made a transfer to journal reserve of 5,000. So this is being done during the year. They made a profit of 26,000 and transferred to journal reserve of 5,000. What was the total ordinary share dividend paid during the year? So at the start of the year they had 86,000. During the year they received a profit of 26,000. So if we simply add up 85,000 plus 26,000, that gives us a value of 111,000, and from that 111,000 they have transferred 5 to the journal reserve, and at the end they are only left with 88,500. So deducting that, we can see that the main difference that they're being left with is of 18,500. So 18,500 is the amount that was paid as the ordinary share dividend. I'll just try to show the working over here again. So like 86,000 is, so let me just show you the working over here. So at the start we had 86,000 as the retained earning, and during the year we added 26 more to it, and then we transferred 5 to journal reserve, and then we must have also given the dividend, and after giving the dividend we are left with 88,500. So we're just doing a simple mathematical calculation. You add 26,000 to 86,000, deduct 5,000, and then take the difference of your answer, that is that will be coming as 107,000. So 107,000 minus 188,500, you will get the amount of dividend, that is 18,500. Sometimes it is easy to do these questions by putting them in a mathematical algebraic form and calculate the missing figure. Now moving on to question number 25. A sports club was formed on 1st August 2020. During the year ended 31st July 2021, the club purchased equipment costing 5,000 paying by check. So they purchased asset costing 5,000. In which of the club's financial statements did this appear? So receipts and payment, obviously, because they were paying for that, so it is appearing in that. We have two options for that, A and B. Income and expenditure account, we do not record any purchase of asset in income and expenditure account. We only record that in a statement of financial position, so we can safely say this is B. November 26, a sports club has 100 members and the annual subscription is $60. So 60 into 100, that makes it like 6,000 total for the year. During the year ended 31st August 2021, 12 members paid their outstanding subscription from the previous financial year. 10 members paid their subscription in advance for the following year. So if 60 is the subscription fee, so 60 into 10 is what we have received in advance, and 60 into 12 is what we have received as outstanding from the previous year. On 31st August, subscriptions for the current financial year were still outstanding from 8 members. So that means 60 into 8 is still remaining. What was the total amount received from members during the year ended 31st August 2021? So if we just do this calculation, so we're being asked what was the total amount received from members during the year. So not the amount that needs to go in the income statement, but actually the amount that was received. So we know that they're receiving this outstanding amount, so 16 to 12, that makes it 720, and this 16 to 8 will make this as 480. So we simply take out this value by adding 720, and this was 600. So the total subscription that were supposed to be received were 6,000. So to do this calculation, we'll simply add in the prepaid amount, because that is what they are receiving. So 6,000 plus 600, and we will also add the amount that was outstanding at the start of the year, and this was 720. So we add 720 to that, and we will deduct the amount that has still not been received, so minus the closing outstanding value, that is of 480. When we work this out, so 6,000 plus 600 plus 720 minus 480 will give us 6840. So the total amount received from members during the year is simply 6840. Now moving on to question number 27. Beth provided the following information: net assets 28,000 at the opening date and the closing date value is 24,000. Her drawings during the year amounted to 300,000. So the drawings are 3,000. What was Beth's profit or loss for the year? Now this is pretty simple. So 28,000 has now reduced to 24,000, where the drawings were 3,000. So we know that this was a loss of 1,000 only, because that's the only way how this 28 can be reduced at 24. Moving on to question number 27. Roshan's sales for his first year of trading were 55,000. His gross profit margin was 20%, so the gross profit as a percentage of sales is 20%, and closing inventory was 3,200. What was the purchases for the year? Now in order to calculate this, as we know that gross profit is 20% of the sales, so 20% of 55,000 will be 11,000. Now we know that the gross profit is 11,000. So if the gross profit is 11,000 and the closing inventory was 3,200, that means that cost of sales that was deducted from the sales of 55 was actually 44,000. That gave us a profit of 11,000. So if the
cost of sales was 44,000. We know that cost of sales comes after purchases less closing inventory. So we have the value for closing inventory, that is 3200, and we know that we're having a cost of sales of 44,000. So definitely the amount that was there for purchases, and we deducted 32,000 from that to get the value of 44,000. That means that purchases amount was 47,200, because from 47,200, when you deduct 3,200, you are left with 44,000. So we can choose option D. And how did I get this 44,000? This was when I deducted the gross profit. I took the difference, because we know that sales minus cost of sales gives us gross profit. So gross profit margin was given to us as 20%. We know gross profit is 11 and sales is 55, so obviously the difference is 44. That will give us the value of gross profit as 11. So one thing is leading to another. We're just going backwards to calculate the final amount of purchases, which is coming as 47,200. 29. Which information is required to calculate the return on capital employed for a sole trader? So return on capital employed is simply the return that the company is getting, that is the profit divided by the capital employed. So the information required for that among the following options is gross profit, non-current liabilities, owner capital, no. Gross profit, non-current liabilities, working capital, no. And C, cooperating profit for the year, non-current liabilities, owner capital, yes, that will be used to calculate return on capital employed, because I have mentioned this earlier that capital employed is your capital invested in the business plus any profits plus any long-term liabilities that are your non-current liabilities. So operating profit divided by capital employed will give you return on capital employed, and this is option C over here. Moving on to question number 30. What is the best indicator of the liquidity of a business? So liquidity of a business is measured by the asset test ratio, as this is considered to be most useful indicator, as it is not including the value of inventory in it, as inventory is considered to be the least liquid among all. And now moving on to question number 31. A business provided the following information about its gross margin. Year 1 40%, year 2 38%, year 3 35%. We can see it is gradually decreasing. What could explain the changes in gross margin? So gross margin is changed due to any changes in the selling price or any changes in the cost of sales. So if cost of sale was decreasing, this would have been increasing. So A is wrong. Expenses are decreasing. Expenses has nothing to do with gross margin, that is part of net profit margin. C, quantity of goods sold is decreasing. Again, if the quantity of goods sold is decreasing, so this will not be the case over here. And selling price is decreasing, so yes, selling price will be affecting the gross profit. Selling price is the reason why the gross profit margin will be declining. Moving on to question number 32. Sam and Rob each own a trading business. The income of each business is solely from the sale of goods. They provide the following information for the year ended 30th June. Return on capital employed. So they have given you ratios for both these businesses. We have return on capital employed, gross margin, profit margin, and current ratio. Which statement is correct? Now before looking at the statement, let's just analyze these figures. So return on capital employed is greater for Bob, gross margin is greater for Rob, and the profit margin is greater for Sam, and current ratio is also more for Sam. So overall there are three values that are showing that Sam is in a better situation. Now looking at the statements, Rob will find it easy to pay his current liabilities. Rob will find it easy to pay his current liabilities. Well, not really, because this ratio is quite close to 1, that is 1:1. So A will not be correct. Rob's expenses are higher proportion of his sales. So B is saying Rob's expenses are a higher proportion of his sales. Well, if Rob's expenses are higher proportion, then that means his profit margin will be lower. So yes, we do see that Rob has a lower profit margin than Sam. So this can be an option, but still we'll look at the other two options. And the C part is saying Sam is not employing his capital effectively. Well, Sam has a higher return on capital employed, so we cannot say this is C. And D is Sam's goods are sold at a higher price. Sam's goods are not sold at a higher price. Why? Because we can see that Rob has a higher gross margin, and we just did a question up where we saw that gross margin will improve with a higher selling price. So we can safely say that B is the correct answer over here, as Rob expenses are a higher proportion of his sales. What we simply mean over here as a higher proportion of sales is that I'll just zoom in to give you a more clear picture. That suppose we have a gross profit margin of 25% and then this profit margin is 14%. So technically they're losing whatever they're losing in between, that is going towards the expenses. So now if Rob's gross margin was 30% and now this has reduced to 12%, so we know that 30 minus 12 will actually give us 18. So that means this 18% that he is losing, that is going in form of expenses, right? So the question did mention that Rob's expenses are a higher proportion of his sales. So yes, it's due to the higher expenses that these values have declined, because technically he had a higher gross margin than Sam, but then his net profit margin has actually reduced, is lower than Sam. So this has only happened because of expenses being higher than the other one and his own sales. Moving on to question number 33. Why would the owner of a business want to see his financial statements at the end of the year? 1. To assess the performance and progress of the business. Well, this is something that is done. Mostly financial statements are showing how the business is performing. 2 is to determine the market value of non-current assets. And 3, to make informed decisions for the following year. So definitely this is 1 and 3 only. Why? Because this financial statements are used, you make your business decision based on the information that is given in these financial values. And no, these financial statements are not just prepared to calculate the market value. So that's why we're completely ignoring number 2. Moving on to question number 34. Charlie is a car dealer. Joe wanted a new car and went to Charlie's car showroom. On Monday, Joe took a car for a test drive and decided to buy it. So he hasn't bought it yet. He decides to buy it. On Tuesday, Joe arranged to pay for the car by the check. On Wednesday, Joe collected the car and received an invoice. On Thursday, Joe's check was cleared by the bank. On which day was Charlie able to account for the profit on the sale? Okay, now this is a very tricky and unique sort of a question. They have given you every day of a week where they're showing you a little progress on this particular trading or this particular deal that is happening of this car sale, and they're asking you on which day was Charlie able to account for the profit on the sale. Now this next question is simply falling under the concept of realization, where we state that we can only record a profit once it has been realized, once the sale has been realized. And this is happening when Joe has actually collected the car and received the invoice, because this is when the sale has actually taken place. He has physically taken the car. This is covering our concept of realization. Unless and until he was still thinking to make a decision, no matter how many times he said that, okay, I promise you I'll come and buy the car tomorrow, we will not be recording that as a sale, because that has not yet happened. So we will choose option C because of the concept of realization. And realization concept states clearly that you only record your profits once they have realized, and record any you are not supposed to record them unless and until they're not realized. Number 35, which accounting objective requires that financial information is provided in time for a decision to be made? So, accounting objective requires that financial information is provided in time for a decision to be made. Comparability, no. Comparability is comparing different financial statements or information. Relevance, yes, relevance is the objective that is being applied over here, because basically you're making your decisions on the accounting information that is presented to you, and that is the relevant data that you're using in order to make that that decision, those economic decisions or decisions regarding the business. Reliability and understandability does not really apply over here, so we choose option B for question number 35. Okay guys, so this was the whole paper. I hope I covered every question in detail, and you guys got a good overview of how to solve these questions. Please do leave your comments or any questions or any further clarifications that you feel you need for any of these questions. I will try to answer them as soon as possible. Please do post any more queries or request of any specific papers that you would like me to help you solve. Good luck preparing for your exam. Thanks for watching.